Hello, I'm Lee, and I'm going to do a video today on Strangles, particularly about trade management on Strangles and how I enter the trades. A few people asked me how I manage my Strangles, how do I enter them, what's my criteria, what sort of information can I give them on how to be better at doing Strangles. So I decided to put together this video just for you. Let's take a look. We'll dive right in. So first of all, I only do short strangles. And what that means is that I sell an out of the money put for a credit and I sell an out of the money call for a credit. Typically, the underlying stock or ETF is priced right in between the put and the call strike prices. And what that means is that I'm neutral on the underlying. That means I expect it to stay within some range. And that range is typically defined by the two strike prices. I want the underlying stock to stay in between my put strike and my call strike. So let's take a look at how I decide what those strike prices should be. So first of all, I like to look at a probability distribution curve. And what I want to say is that it's expected to stay within some range. And that range is defined as plus or minus 1 sigma or 1 standard deviation. And we call that the expected move. Now, your broker will put this in the table of all of your strikes. And for each expiration date, they'll tell you the expected move based on the probability distribution curve. So I like to just do a strangle right at the expected move. You could do it other ways too. You could use technical analysis, for example. You could look at it and decide where there's regions of support and resistance, and you can decide what the expected move is or where the underlying stock will be ranging. Keep in mind, you want it to stay in between your two strikes. So you want to select a call strike and a put strike that should encapsulate the underlying stock price at the time of expiration. So let's take a look at an example. I did a short strangle on Disney on March 10th, 2021. Now, if you look at the underlying chart, you can see that Disney was a little bit bullish in this time frame, and it's kind of weird to be doing a neutral strategy when the chart is so clearly bullish. But a lot of times with a strangle, it doesn't matter if it's bullish or if it's bearish. There's still an expected move. And even if it's going to trend upward, as long as it doesn't breach your expected move on your call strike, you'll be fine. So let's take a look at what I did. The stock price was trading for $196 at the time I did the trade. And I wanted to do a 44 days till expiration short strangle. So that expires on 4/23/21. So I sold a call option expiring in 44 days with a strike price of $220, and that was a 19 delta. And I sold a put option with a strike price of 167.50, and that was a 12 delta. And what you can do with a delta is you can use it as a rough approximation of the likelihood of expiring in the money at the time of the strike's expiration. So what I can say is that based on these deltas, I had a probability of profit that was roughly 70%. That means that 70% of the time that I do this trade based on the probability distribution curve, the premiums that I'm going to collect, and the deltas, that this would be a profitable trade. So I'm looking for the stock to essentially stay within this triangle. The price can go up and it can go down. I don't care. But as long as it stays within this triangle, I'm going to collect money by theta decay. So when I sold this, I sold to open and I received a $418 credit. That means I was paid $418 to sell this call option and this put option. And what that means is that I had a break-even point of $224 on the top side and $163 on the bottom side. So that means that as long as the stock price stays below 224 and stays above 163, I'll make money or at least break even. Okay, and in this case, it had a buying power reduction of $23.82. That means that I had to set aside $2,382 with my broker. That money couldn't be used for anything else. It was on hold in reserve to support this trade. So that's the amount essentially that I had invested into this trade. Okay, so collected 418, put in reserve 2382. Okay, so let's see what actually happened. 21 days later, you can see that even though Disney was quite bullish going into this, it took a downward turn and it went down for 21 days straight practically. And it kind of rode my yellow line here. And it looks like that would be a bad thing. A lot of times when you are trading stocks, you think that you want stocks to go up. But with a strangle, really, you're just wanting time to pass because you're collecting theta decay. The stock can move up, it can move down. You don't care as long as it doesn't do anything too crazy. And in this case, it just followed the path that I had laid out for it, really. So 21 days go by and I bought to close the strangle for $119. Now keep in mind, I sold to open for $418 and I bought to close for $119. That means I was paid 70% of my max profit potential for this trade. So my profit and loss in this example was $299. That's excluding my commissions, which was like $2. Let's see. My return on capital was 12.55%. What does that mean? I made $299 on my investment of $23.82. That's 12.55% return on capital. I did that in 21 days. It was days in trade equals 21. And that's an ROI or an annualized ROI of 680%. So that's a darn good trade. I mean, I only made $300, but I only invested $2,300 and it only took 21 days. And if you could do that all day, every day, that's 680% on your account annually. So I think this was a great example of a short strangle working out perfectly. So, and in this case, what's important to realize is that the profit all came from theta decay. As the options approached expiration, the value of the option premium or the extrinsic option premium went towards zero. So as we went down this curve, we started making more and more money until eventually, after 21 days, we exited out and we took our profit. So let's do another example. Let's see, this is Boeing. And what you can see from this chart is that Boeing is just ranging. We did this on March 5th, 2021. And in this case, you can see that it's pretty much flat. It went up a little, it went down a little. So this looks like a good one for a strangle because it looks like it's moving within a particular range. So let's see. The underlying price at this time was $228. So what we did was we picked an expiration date for 16/21, which was 42 days away. So it was 42 days until expiration. So what we wanted to do was have the stock stay below 275, which was a 17 delta call strike, and stay above 175, which is an 8 delta put strike. And looking at that, it has a probability of profit of about 75%. So this is a pretty good, pretty safe trade. We have a 75% chance of making money on this trade based on the normal distribution curve. So what we're looking for here is that this stock stays within this triangle, that it can go up or it can go down. We don't care too much, just as long as it doesn't go up or down too fast or do anything crazy. We especially don't want it to go outside of our green lines. In this case, we were paid $508. We sold to open a short strangle. We were paid $508 in premium to do that. And that means that our break-even price on the top side was 280 and on the bottom side was 170. And that means that I would make money or at least break even as long as the stock did not fall below 170 and it didn't go above 280. That's over $100 range. I needed Boeing to stay within this $100 price range for 42 days so that I could make maximum profit potential. Okay, so let's take a look at our buying power reserve, or buying power reduction, was basically $2,800. That means that my broker made me set aside $2,800 for this trade. So whatever profit I make on this trade, I can compare it to my $2,800 to figure out my return on capital. So let's take a look and see what actually happened. 10 days later, it jumped up to $276. Look at that. The chart just went crazy. It was flat for a couple months, and then all of a sudden I put on my trade and it shoots up. Now at the time that I was looking at this, the price was $276. This is actually above my green line and almost hitting my red line. So I decided that I had to do something about this. I decided to roll up and roll out. And in this case, we're going to roll the untested side up and we're going to roll both of them out. So let's take a look at what I did here. I had the 275 strike, which at this point was a 54 delta. And I had the 175 put, which was only a 2 delta at this point. So what I did was I rolled up the 175 put and turned it into a 215 put. It was now a 9 delta. And I took the expiration date and I rolled it out 14 days to 4/30, which was 46 days away. A lot of people have said things like, rolling is just accepting a loss and moving on. Well, in this case, I didn't roll the losing call option. I only rolled up the winning put option so we could get a stronger position. So we didn't accept any losses. We didn't have any realized loss on the overall trade. As a matter of fact, we got paid another $543 to do this roll. Because we moved it out 14 days and because we moved from a 2 delta to a 9 delta, we actually received another $543. So that means that we've collected so far something like $1,050 on this trade. Now our break-even price changes too, because we have more margin, more room. Before we only had a $500 credit, and now we have a $1,000 credit. So that widens out our break-even. So I now need it to stay below 285 and above 204 from now until expiration, 46 days in the future. Okay, so that's how we set it up. So let's see how that played out. A couple days go by and we can see that it dropped down and then it kind of came right back up. And now we're 43 days from expiration, and I'm starting to get a little bit worried about Boeing being bullish. It shot up and I thought, okay, that's fine. I'll roll up my put. It came back down and I said, okay, that's what it's supposed to do. Everything's great. But then we had another big green bar and I'm thinking Boeing is super bullish. It's super strong this week anyway. So I better get ready to handle Boeing continuing to go up. So what I did was I observed the fact that my deltas were out of balance, that it was still bullish, and I sold another put to rebalance the strangle. So normally with a strangle, you just have one call and one put. But in this case, I just sold another put. And what I did was I sold a 230 strike put option, which gave me another 20 deltas. And that basically neutralized my deltas so that if the Boeing underlying price went up or down, that I would make the same amount of money with a move in either direction. So let's take a look at how that played out. I got a credit for selling that extra put, $535. Now, we've sold 3 puts at this time, and we've collected a total of, what is that, $1,550, almost $1,600. And we still have 43 days until expiration. We've collected $1,600. So what we see happen here is that our break even moves up for both of these. Now, as long as the stock price stays below 293 and stays above 213, we're profitable at the time of expiration. But it did have an effect on my buying power. It took an extra $2,100 of buying power to be in this position. But I felt like it was a good investment because I was now neutralized. I had less risk of a movement because it was a more balanced neutral position. So let's see how this panned out. I want it to stay within this triangle, and let's follow it away, and boom, the next 4 consecutive days it went down, 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 and down. And now all of a sudden it's starting to approach my short put that I sold. So what am I doing here? I'm just getting whipsawed. I did an adjustment, I did another adjustment, I did another adjustment, and every time I do an adjustment, it kind of moved against me. So what I said is, you know what? Let's just sell another call. We'll rebalance everything, and we'll put a call over here at the 300 strike price, which gives me another 11 delta, and that kind of neutralizes the whole thing again. And when I sold that one, I received another credit of $190. I don't know what that works out to be. Something like $1,800. It doesn't matter. So I have these 4 options in place. It's no longer a strangle. I don't know what to call it. It's 2 strangles. 2 strangles that expire on the same date, 38 days from now. And going forward, I want this to stay within my triangle over here. Oh, but selling that extra call option, it actually increased my break-even point to 295. And on the bottom side, it lowered it to 212. So by selling an extra option, what it did was it widened out how much room I had to be right. My break-even point got considerably wider, but it did cost me some buying power reduction. Now, instead of $4,000, I was at risk for $8,000 of buying power reduction. Or this is an undefined risk play to begin with. So this $8,000 is how much I had to put in reserve with my broker to satisfy them that I had the money set aside in case we lose money. It was roughly $8,000. I don't know the exact amount, but we'll just call it $8,000 for this example. Okay, so what happened was it went back up. It was 30 days till expiration, and what I could see is that the actual underlying price was just perfectly centered in between all of my options. And I thought to myself, you know what? This thing's been all over the place. It's been up, it's been down, it's touching all of my strike prices. I don't really like the way this is going. Enough time has passed. I've managed it. I've been whipsawed. I've collected theta for a number of days. Let's just go ahead and get out of the position. Right now, it looks good. It's centered perfectly. I've collected the theta decay, and let's take a look and see how much money we can actually make if we just close the position today. So what I did was I bought to close this for $1,406. That's out of more or less $1,800. And this was 20% of my max profit. That's not great. We like to get 50%, 75% of max profit. But in this case, it was kind of jerking my chain. So I decided, let's just take our 20% and run. And what I did was I had a profit of $362. And that was a return on capital of 4.5%. That's $362 on my buying power requirement of $8,000 is 4.5%. Now, that's not exactly accurate because I started off with only $2,000 in reserve, and then it was $4,000 in reserve, and then it was $8,000 in reserve. So if we really wanted to calculate perfectly the return on capital, we would have to take an average of the buying power requirements at those given times, but we're just going to lump it all together and say it was $362 profit on an $8,000 investment. And we did that for a total of 18 days. That was a crazy 18 days, up and down for 18 days. But still making $362 on $8,000 in 18 days So that works out to be 144% ROI. So what you can see is that a short strangle, even one that went bad, even one that went poorly, still had a really nice rate of return. We're pretty happy with this trade. It bounced all around, but we managed it. We sold more options. We rolled options. We rolled the date. We rolled the untested side. We took more positions, and we basically just managed this strangle to make sure that it was profitable. And eventually we had a return of 4.5%. Okay, so that was a pretty good summary of how we managed a strangle that had gone bad on us. What you saw was that we did these two different strangles. One was incredibly easy. It just stayed within our expected range. It didn't do anything crazy, and we had a great ROI. And then another example, we had Boeing, which kind of went all over the place, and it took some management. Maybe we overmanaged it, but I think we did a pretty good job. 144% annualized ROI is a great rate of return. It outpaces the market by something like 10 times. So I'm pretty happy with this trade. It was a small amount of capital and a small amount of profit, but it was a great ROI. We have a lot of these going on at the same time. So to collect theta decay day after day after day is the name of the game. So that's some examples of strangles. You pick your expected move and you try to make sure the underlying stays within it. And if everything works out, you get to collect your max profit or some percentage of your max profit by managing the trade early. Okay, thanks for having a look, and I hope you enjoyed this video. Hit the like button down below.